Joining me now, we've got Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Brian, you're expecting pressure on the market from the end of June to the end of July, but you have some picks that you say are well positioned for any outcome, the good, the bad, the ugly this summer here. Walk us through that.
Yeah, absolutely. So there's some pretty big questions that still need to be answered for this recent market rally to kind of be confirmed. We have some, trade negotiations, but only one firm deal that is permanent and long-term with the UK. There are other negotiations ongoing, including with China, but they're very temporary at this moment in time. And until we start to see more of a permanent deal take shape, there has to be some volatility that probably comes along with what we're seeing on a day-to-day negotiation, what comes out of that. So we want to see more of that, but also at the very same time, Congress is negotiating the next budget deal that's going to include very important outcomes when it comes to personal income taxes as well as corporate income taxes. If you think tariffs are a major headwind, the corporate tax rate simply going back to where it was before would be from 21% today back to 28% where it was in 2016. That affects everybody. The thing about tariffs is you actually have a decision. You can actually avoid or minimize that tariff impact by simply buying things that are made here domestically and avoid that particular cost increase. But taxes impact everybody across the board. So those are still very large question marks that need to be answered over the summer months. Coincidentally, we know that the time frame comes to about basically July or August when these questions need to be answered. That's when basically the 60 and 90-day windows that are out there for trade negotiations expire. And we also have to have a budget passed by the end of August or early September. So that makes us ripe for some more volatility over the summer months until we get more clarity on the outcomes of these big questions that are still in front of us.
And so another big question in front of us is on the interest rate policy side. We've gone from a probability of 100 basis points of cuts over the course of this year and to the end of this year to now just 50 by the end of the year based on the CME Fed Watch and my last check just before the show. So where does the Fed sit within how the markets are kind of ranking all of the different inputs that need to be considered and ultimately worked through in the minds of investors?
Yeah, absolutely. At Zacks, we've always kind of been in the camp of one or two rate cuts makes the most sense simply because the underlying economy is still pretty firm. And I think we've heard that now from a number of Fed speakers this week, as well as what we got from the latest FOMC meeting and the Q&A from Chairman Powell, is that most of the hard data, economically speaking, is still pretty firm and pretty solid. Retail sales, pretty strong, employment still pretty strong. All of that kind of stuff leads us to a structure where prices aren't really coming down to that 2% target, so why would we have room to lower interest rates at this point? Something else has to change in the data before we're going to see a change in monetary policy. That also probably takes time, probably likely in that Q4 type of range. So September, October, November, maybe we get one or two rate cuts later in the year because by then we'll have continued to make progress against that inflationary goal of getting prices down to 2%. So yes, it's still a big impact. That means that rates remain above 4% for the majority of this year. And as rates stay higher for longer, that is a material headwind in terms of the cost of capital. And it does impact earnings negatively the longer rates stay higher. So that's certainly one issue that's out there. I think that's been very known for a long time. And managers of businesses have been able to kind of, I think, absorb that understanding that rates are not likely to go down by 100 basis points as the market wants it to. I certainly understand that lower rates would be better for growth, but there has to be a reason to do it. And the data just simply isn't taking shape at this point in order to push rates down that much, at least right now.
And so with the time that we have left, Brian, I just want to circle back to some of the companies, the types of companies or balance sheet characteristics that you're prioritizing in your top summer stock picks.
Yeah, absolutely. So with all of these headwinds in mind and the volatility that could be in front of us, we like stocks that are a little bit more durable in terms of their earnings structure. One being JP Morgan. Think about this. Banks don't really pay tariffs. And if there is such a big business investment boom that's going on, and there is certainly Q1 GDP showed us business investment up 22%, then that's going to need financing. And we think large multinational banks will play a big role in that, a diversity of income generating segments in their balance sheet. Obviously, investment trading did well. Investment banking is continuing to pick up. So this is a good name that doesn't really get subject to tariffs, and a very strong balance sheet at this point in time. A name that's already up 11% on the year, doing much better than the broader market. Also, other areas of investment, right? Piggybacking on that business investment, you can look at things like John Deere and Caterpillar, where there are going to be literally shovels in the ground for these infrastructure projects. Data centers and infrastructure are going to be necessary for growth in what new manufacturing being onshored is going to actually be able to accomplish at this point in time. So these are names that have very durable earnings structures, strong balance sheets with lower levels of debt, a good dividend payment for those patient investors as well. And looking at Caterpillar, their backlog of orders is now over $35 billion. So the future profitability of the company looks very strong. And you got John Deere that's working on innovation, both internally for production policy, but also making farmers more productive using AI technology as well. So these are just good, durable names that can really help your portfolio withstand volatility over this period of time. We believe that there's always a reason to be invested. Right now, you want to focus on higher quality stocks with higher quality balance sheets and a strong dividend.
Brian, good to see you. Thanks so much for taking the time.
Thank you.